Following Warren Buffett's advice is never a bad idea. The Oracle of Omaha, a billionaire investor, has a wealth of knowledge and advice available to those willing to listen. In addition, his annual meetings and shareholder letters provide valuable insight into how to approach investing in light of market conditions. In particular, one piece of his advice could be extremely valuable to investors today, potentially saving you from significant losses. The most important thing to do if you find yourself in a hole is to stop digging. He says if you've lost a lot of money on an investment. And there's a lot more, so let's dive into today's video to know how to invest in 2022 and some tips by Warren Buffett. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. Begin early. Start investing now if you haven't already. Buffett believes that the sooner you get into the game, the better. Don't put your money on individual stocks. Buffett strongly advises against stock picking. The trick is not to pick the right company, to buy all the big companies through the S&P 500 and do it consistently and at a very low cost. You never want to give the impression that you can pick and choose. Concentrate on value rather than market timing. Buffett reminded shareholders that he never knew what the stock market would do in the short term, which is why timing the market is a bad investment strategy. Investors who believe they can enter and exit the market at all times are extremely unlikely to be successful. When investing for yourself, remember the value you're getting from the investment on how much you're paying relative to what the asset will produce, rather than whether you believe the price will rise or fall immediately. Make sure your portfolio is built to survive. He emphasized the importance of keeping enough cash on hand to ensure the company can always survive, particularly during market panics similar to the 2007 to 2009 financial crisis. Buffett stated, "We will always have a lot of cash on hand. There have been a few times in history, and there will be more times in history, where you don't get to play the next day if you don't have it. It's similar to oxygen," he added. "It's always there, but if it goes away for a few minutes, it's all over." You can apply the same logic to your own portfolio. Avoid taking positions that could result in a permanent loss or employing techniques that could harm you during a crisis, such as a margin trading. A cash emergency fund can help you survive the inevitable crisis in your own life. Conduct your own research. Buffett advised shareholders to learn what you know and what you don't know, and once you've learned enough about what you're investing in, to feel confident about it. Don't let the opinions of others deter you from doing what you believe is best. But he further added, you can't look around for people who agree with you, and you can't even look around to see if anyone knows what you're talking about. Invest in low-cost index funds. Buffett swears by one simple tip for increasing retirement savings. He says buy an S&P 500 low-cost index fund consistently. He believes it is the thing that makes the most sense almost all of the time. Also, investing in productive assets is the best way to go. When it comes to investing, investors have a plethora of options. Buffett reiterated his preference for assets that generate value for their owners. Stocks, bonds, real estate properties, farmland, and other investments all fall into this category. Cryptocurrencies have recently exploded onto the investment scene, attracting a lot of attention from traders and the media. But Buffett has made it clear that he is not a fan. According to Buffett, owning an apartment building generates rental income, and owning farmland generates food, but cryptocurrencies such as Bitcoin generate nothing for their owners. That explains the difference between productive assets and assets that rely on the next guy paying you more than the last guy, he explained. So avoid Bitcoin and other cryptocurrencies. Buffett and Munger both stated unequivocally that their views on Bitcoin and cryptocurrencies have not changed since they first warned investors about their risks. Buffett called Bitcoin a mirage in 2014, but Munger, 98, went even further, saying that he tries to avoid stupid and evil things that make him look bad, and Bitcoin is one of them. Bitcoin, according to Munger, is stupid because it's very likely to go to zero, and evil because it undermines the Federal Reserve and the national currency system. Understand the Buffett-Munger approach. Warren Buffett and Charlie Munger are one of the greatest business and investing teams of all time. Under the tutelage of Benjamin Graham, Buffett developed his value investing philosophy. Munger, on the other hand, decided to change careers after meeting Buffett. Prior to taking over at Berkshire Hathaway, the Buffett-Munger team invested through their own partnerships. outperforming the Dow Jones Industrial Average Index by a wide margin. Although they viewed investing through the discount to intrinsic value lens, their philosophies differed vastly. While Buffett preferred to buy low-quality businesses, Munger focused on high-quality businesses at a reasonable price. However, Buffett shifted to Munger's approach after meeting at Berkshire Hathaway's helm. Although their investment philosophy is simple to grasp, it is difficult to implement. They focus on 4 factors. First is long-term economic business characteristics that are favorable. Second is management, which is competent and honest. The third is an attractive purchase price, as against the yardstick of value to a private owner. And finally, an industry that investors are familiar with and can assess in terms of long-term business characteristics. These 4 points serve as the foundation of their investment philosophy. The concept of a moat, popularized by Buffett, flows from the first point, and the importance of investing in businesses one understands flows from the fourth. In any case, Buffett and Munger are skeptical of the notion of calculating the cost of capital. Munger in particular has made no secret of his contempt for academic perspectives on the subject. What about investing during high inflation? Buffett says the best thing you can do is excel at something. He further said, citing doctors and lawyers as examples, that people will give you some of what they produce in exchange for what you deliver. Why is everyone so preoccupied with inflation? Skills, unlike currency, are inflation-proof, according to Buffett. So if you have a skill that is in demand, it will remain in demand regardless of the value of the dollar. Whatever talents you have, they cannot be taken away from you. They can't be inflated away from you, he explained. By far, the best investment is anything you develop yourself, and it's not taxed at all. It's similar advice to what Buffett gave at the end of the Great Recession in 2009. He said, the best thing to do is invest in yourself. At the time, Buffett also stated that the next best thing a person could do is invest in a wonderful business that produces products that are in high demand regardless of how the dollar performs. The best businesses during inflation are the ones you buy once and then you don't have to keep making capital investments later, he had said. Conversely, any business that requires significant capital investment is a poor business to be in during inflation, and it is frequently a poor business to be in overall. Buffett recommends investing in real estate during periods of high inflation. It's especially useful to own real estate during inflationary times because the purchase is a one-time outlay for the investor and has the added benefit of being resold. If you have something useful to someone else, it tends to be priced in terms of replacement value over time, so you really get the inflationary kick, he added. Buffett advises investors to invest in low-cost index funds to reduce risk. He has also advocated for the purchase of funds that hold every stock in an index, making them automatically diversified. Meanwhile, Buffett's Berkshire Hathaway has made significant investments in technology stocks. Berkshire Hathaway owns billions of dollars in Apple, Amazon, and Snowflake. Now we come to investing in overvalued markets. Warren Buffett has always been a believer in the power of value investing. It means he prefers to buy undervalued stocks with the potential to recover and provide good long-term returns. Unfortunately, many such stocks can also be found in an overvalued market. For example, sectors and industries that are currently struggling, like energy. Buffett also prefers to focus on valuation over the possibility of rapid growth. Stocks that are on the tier are usually overpriced, but people continue to buy them in the hope that the rapid growth will compensate for the overvaluation. On the other hand, Buffett suggests focusing on stocks that are trading at a discount to their intrinsic values. But perhaps the most important principle of all is to invest for the long term. Rather than considering what might be a good investment in a few months or a few years, investors should consider which investments will provide good returns over the next few decades. People who take long-term view of assets are less concerned about short-term market fluctuations. Finally, we have the tip for investing as interest rates rise. Buffett earlier said that the most important item in valuation over time is obviously interest rates. If interest rates are destined to remain at extremely low levels, it increases the value of any stream of investment earnings. The stumbling block is always what government bonds yield. You can choose your maturity. It is also evident in real estate. Real estate yields respond quickly and directly to interest rates, he added. The same principle applies to stocks. Any investment is worth all of the money you'll get out between now and Judgment Day, discounted. What do you think of these tips by Warren Buffett about investing? Let us know in the comments below.